Banduwe Pute, as we promised in our previous lesson, today we are going to meet you with another important area of the syllabus. This is a part of NanaJaya seminar series organized by the Bank of Ceylon. So today we are going to discuss another important area in the syllabus. So unit number 12, limited companies. In a previous lesson, we covered share issue part. New share issue account, share issue expenses, impact on cash, stated capital, rights issues, capitalization of reserves. Those areas we discussed in a previous lesson. So now today we are going to discuss the questions covering financial statements of limited liability company. So if you consider the financial statements of limited liability companies, mainly we have 5 components. We call components of financial statements. So mainly we identify 5 components of financial statements. The statement of profit or loss and other comprehensive income, statement of changes in equity, statement of financial position, statement of cash flows and accounting notes and policies. Right. So here I am going to discuss with you model questions from 4 financial statements excluding statement of cash flows. The statement of cash flows we will discuss in a separate lesson. We will meet with another seminar, another program to discuss statement of cash flows. So here today I am planning to discuss questions excluding statement of cash flows. These questions mainly focusing excluding statement of cash flows. The cash flows we will discuss later. Right. So question number 1. To go through it. So question number 1, the responsibility of preparing and presenting of financial statement. The responsibility of presenting financial statements, preparation and presentation. Right. So when we discuss when you look at this question, you will think that accountant is responsible for preparation and presentation of financial statement. The legal responsibility is not with the accountant. What the accountant does, accountant and his department, they prepare the financial statements. They get a salary, for that they work. But according to the law, preparation and presentation of financial statements is a responsibility with the owners or the board of directors. The responsibility of preparation and presentation of financial statements is with the board of directors. So answer number 2, second answer. Preparation and presentation of financial statements are responsibility with the owners or the board of directors. Out of the 5 answers given, answer number 2. Answer number 2. So question number 2. To go through it. The question, select the correct answer which includes the equity in the statement of financial position. Equity. Equity of a limited liability company. And then in the equity, we have mainly two elements. When it comes to equity, it has mainly two elements: stated capital, stated ordinary share capital, stated ordinary share capital, and reserves. When it comes to limited liability companies, equity mainly consists of stated ordinary share capital and reserves. And we are learning three reserves here. Revaluation reserve, general reserve, and retained earnings. Revaluation reserve, general reserve, retained earnings. The retained earnings we call accumulated profit or retained profit. Right. Stated ordinary shares. The ordinary shares, first answer, ordinary shares creditors. First answer, credit is a liability. It's not a part of equity. Creditors, it's liability. You can exclude this. Creditors is a part of your liability, so then you can exclude this answer. Second answer, ordinary shares correct, reserves correct, but lease liabilities. The liabilities is not a part of equity. Liability is not a part of equity. Third answer, lease liabilities. The lease liabilities, we can exclude this answer by liability is not a part of equity. Fourth answer, ordinary shares correct, bank loans. The bank loans are liability. Bank loan is a liability, so you can exclude that answer. The fifth one, ordinary shares, reserves, retained earnings. The mainly equity consists of ordinary shares and reserves, revaluation reserve, general reserve, and retained earnings. Then the retained earnings, the question has separated. The retained earnings, then ordinary shares, reserves, and retained earnings. It's true, retained earnings are part of reserves. Retained earnings are part of reserves. Then you can accept the answer number 4. You can select the answer number 5 out of the answers given. To question number 2, second answer. Right. We'll go to the next question. So go through it. So question number 3, which of the following is not a part of the statement of changes in equity? Which of the following is not a part of statement of changes in equity? The statement of changes in equity. So this is also one of the main component of financial statements. Statement of changes in equity is one of the main component of financial statements. So how we identify this? Statement of changes in equity shows the changes in equity. In the previous question, I explained you equity. Equity mainly consists of stated ordinary share capital, and reserves. And the statement of changes in equity shows the changes or the movement of a stated capital and reserves during an accounting period. Right? It shows the capital at the beginning, correct, and at the end of the period, correct. Why we define it? We identify the statement that shows the changes in the equity during the period, changes. The receipt of dividend. The receipt of dividend is an other income. The receipt of dividend is an other income. The payment of dividend is a reduction of retained earnings. You record. The rights issue, when you make a rights issue, you record as an increase in the statement, in the stated share capital. So, correct. So, the answer, which of the following is not a part? Not a part is receipts of dividend. Why? Receipt of dividend you record as an other income. Receipt of dividend you record as an other income. So, the correct answer is receipt of dividend. It is an other income. You record it in the statement of profit or loss and other comprehensive income as an income. So, question number 3, answer number 3. So, question number 4, the component of financial statements. The components of financial statements. So, what are the main components of financial statements? What are the main components of financial statements? And in the financial statement, mainly you have 5 components. At the introduction, I explained you 5 components of financial statement. The first one, statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. The second one, statement of financial position. Second component, statement of financial position. The third one, statement of changes in equity. Third component, statement of changes in equity. The fourth one, statement of cash flows. Statement of cash flows. The fifth one, accounting notes and policies. Accounting policies and explanatory notes. So, these are the main components of financial statements. These are the main components of financial statement. And in a previous lesson, you may have learned elements of financial statements. Elements in financial statement. You have 5 components of financial statements and 5 elements in financial statements. So, what are the 5 elements? You have 5 elements also. 5 components, 5 elements. The 5 elements are income, expense, assets, liabilities and equity. To clearly understand the difference, 5 components of financial statements and 5 elements in financial statements. These are components, those 5 are elements. Income, expense, assets, liabilities and equity, those are elements. Now we will move to the question. The question is, what are the components of financial statements? components: profit or loss and other comprehensive, statement of financial position, changes in equity, cash flows, notes and policies. We'll go through the answers. A statement of comprehensive income, correct. Statement of financial position, correct. Management report, the management report. So you can't get the final answer, you can't get the first answer, but it says the management report. Second answer, the bank reconciliation statement. If you remind the 5 components again: profit or loss, financial position, cash flows, changes in equity, policies, notes. So here bank reconciliation, you can't take the bank reconciliation. The second answer also we can't take. Third one, statement of comprehensive income, correct. Financial position, correct. Changes in equity, correct. Accounting, cash flows, correct. Notes and policies, correct. Then you can select the third answer as the correct answer. Comprehensive income, financial position, changes in equity, cash flows, accounting, notes and policies. If you again want components, elements, 5 components, 5 elements, 5 components and 5 elements. Right. Then the question number 4, can select answer number 3. So question number 5, to go through it. To question number 5, what is the financial statement that shows the operational results? The financial statement that shows the operational results. And if you go back to your 5 components, statement of profit or loss and other comprehensive income, statement of cash flows, financial position, changes in equity, accounting, notes and policies. Right. The purpose of these financial statements. The statement of profit or loss, what's the purpose? Statement of profit or loss, the purpose is to show the operational results. By operating, whether you got a profit or a loss, operational results. The statement of financial position, what's the purpose? Purpose is to show the financial position, as the name says, financial position. The financial position means the value of assets, liabilities and equity. The statement of changes in equity, purpose is to show the changes in share capital and reserves, changes in equity, share capital and reserves. The statement of cash flows, the purpose is to show the changes. In cash and cash equivalents. The later will cover the cash flow part. Then accounting notes and policies, to explain, to show what are the accounting policies they have used in preparing the financial statement. Right. Then the question, operational results. Statement of profit or loss and other comprehensive income. Statement of profit or loss and other comprehensive income. The financial statement that shows the operational results is the statement of profit or loss and other comprehensive income. Fifth question, answer number 2. Question number 6. To question number 6, the dividend tax paid by a company based on gross dividend paid should be, and when a company makes a dividend payment, when a company makes a dividend payment, you pay a tax based on the dividend tax. Right? Dividend tax companies consider as a part of their dividend, right? Where you debit dividend in the retained earnings. Companies paying dividend from the retained earnings account. Cash entry you credit, cash control account you credit, debit entry goes to the retained earnings account. So tax payment on dividend tax also you debit to the retained earning account. Dividend tax also you debit to dividend payment, you debit in the retained earnings account. Answer number 3. To question number 7, the following financial statements are available for consideration. The question is, out of the above statement, correct, incorrect one. Take the first one. The main objective of financial statements we have learned. The main objective of financial statement is to provide information for decision making. Right? To whom? To the stakeholders. But here it specified. Here it specified to assist directors. And here they are specifying. When we explain the purpose of financial statement, to provide information for the users. It doesn't specify specific group. It doesn't say these are the specific stakeholders. Right? The first answer, first statement, you can reject why it specified the specific group. So we can ignore. The second one, financial statement provide information to the users. Yes, users. To take decisions for the users, it provides information, correct. Third one, financial statements show the results of the stewardship of management. Right? How this financial statement is results, you have operational results, financial position, through that you can identify how the management runs a business. You say these companies are good companies, these companies are underperforming companies. How can you say? Looking at the financial statements. Through financial statement, you can identify how the directors are managing the companies, whether they are managing in a good way or they are not properly managing the company. Show the results. The financial statement shows the results of management. So that you can identify whether they properly manage or not. Second and third answers are correct. Second and third answers are correct. Second and third are correct. So you can select the answer number 2. Select the answer number 2. Seventh question, answer number 2. Go to the next one. the following information to answer question number 8 and 9. A company which commenced its business on 1st April 2019 with a stated capital of 75 million. This is the date they commenced the business. At the commencement, introduced stated capital 75 million. Has given the following information for the years 2021 and 2020. They have commenced the business. The operations has been started in 2019 1st April. Then 2 years results. And this is the first year results. This is the second year results. 2 years results. The first year results and second year values. Total income, total expense excluding income tax. This is important. Excluding income tax. Income tax is also an expense for a company, but it excluding income tax. Income tax separately given. Dividend payment, first year you don't have tax and dividend. Revaluation surplus, second year. Total assets for both years. These are the details. Company which commenced operation with 75 million rupees has given 2 years results, first year and the second year. We'll go to the question pattern. Right. Do you have two questions? First one, what were the total liabilities as at 31st March 2020? This is at the end of first year. At the end of first year liabilities. The ninth question, what was the equity as at 31st March 2020? 31st March 2021. This is 20 first year end. This is 21 second year end. End of second year. End of second year. Question number 8. Question number 8. Liabilities at the end of first year. Question number 9. Equity end of second year. We will make the calculations. Thus you have the paper question. Question number 8. The question number 8. If you want the question again, question number 8. What were the total liabilities as at 31st March 2020? End of first year. What are the liabilities? We can make the calculation for question number 8. Question number 8. And if you remind the basic accounting equation, the basic accounting equation, assets equal equity plus liabilities. Asset equal equity plus liabilities. And what's the question? Liabilities. The question is liabilities. So this value you have to calculate. You have to calculate liabilities value. Assets value given. The assets value given as 80 million rupees. This is given 80 million rupees. Then if you know the equity, the difference will be liabilities. If you know the equity, the difference will be liability. So we can calculate the equity. We can calculate the equity. How? The opening capital, the company has commenced with 75 million. 75 million. The first year profit or loss. The first year profit or loss you can add. Profit or loss. How can you calculate? Income and expense. So how much is the income? First year income is 100 million rupees. Add. Expense, first year 120 million rupees. Expense, first year 120 million rupees. 120 million rupees. Due to expense, your equity decreases. Then you can calculate the value of equity. 175 million plus minus 120, equity 55 million rupees. You can bring it here. You can bring the equity value here. Then you can calculate the difference as the liabilities. As it's 80 million, as it is 80 million, equity 55 million, then the liabilities will be the difference. You can write the liabilities as the difference. The answer is 25 million. Assets equal equity plus liabilities. The question number 8, then you can select the answer. 25 million rupees. Answer number 4, fourth answer. Right. The question number 9. The question number 9. What was the equity as at 31st March 2021? Second year equity. Right. Second year equity. And we have already calculated. We have already calculated first year end equity. We have already calculated the first year equity. How much is it? The first year equity we have calculated as $55 million. 55 million we calculated earlier. Now the second year results you can adjust. You can adjust the second year results. The second year profit. How much the income in the second year? The second year income is 150 million. Second year income is 150 million. Second year profit calculation. Second year profit calculation you can take separately. Second year income. How much is the income the second year? The income 150 million. Second year income 150 million. Plus second year expense. Expense 90 million minus. And the tax. Second year tax. Why this expense excluding income tax? The tax you minus 20 million. 20 million. The second year profit after tax is 40 million. This profit after tax second year. And the second year you have paid dividend. Second year you have paid dividend. When you pay dividend, your equity decrease. Second year dividend payment is 10 million, you minus. When you pay dividend, your equity decrease. The second year revaluation reserve. You have a revaluation reserve of 5 million. Revaluation reserve of 5 million. Then you can identify equity of the at the end of the second year. Equity at the end of the second year value. So how you calculate it? First year equity 55 million, second year income minus expense minus tax, you get tax second year profit, and dividend payment. When you pay dividend, equity decrease plus revaluation reserve to get answer. The revaluation reserve is 15 million. The revaluation reserve is 15 million. Second year, end of the year equity. 55 plus 40 plus 110 minus 10, equity is now 100 million rupees. Second year equity is 100 million rupees. The answer for the question number 9. What was the equity at the end of the second year? 100 million rupees. The answer number 3. Third answer. The third answer. If you want calculation again, the first year equity we calculated. Second year income minus expense and tax minus dividend and revaluation reserve. So you get the equity as 100 million rupees. You get equity as 100 million rupees. To question number 8, 25 million. To question number 9, 100 million. 8th, fourth answer, 9th, third answer. To next question. To go through it. The state capital of a company consists of 500 ordinary and preference shares. The ordinary share capital is 500,000 shares. The company pays 3 rupees and 50 cents per share as interim dividend. They have 500,000 shares. Each share 3 rupees and 50 cents. 3 rupees and 50 cents. The 500,000 shares, each share 3 rupees and 50 cents. You get the total dividend value. But there is a tax of 10%. There is a tax of 10%. Gross dividend value, full dividend value 500,000 into 3 rupees and 50 cents. The question is, what is the correct journal entry which shows the net dividend payment? Net dividend payment. Net dividend payment. Right. We'll make the calculations. The company has 500,000 shares, each at 3 rupees and 50 cents per share dividend. The 500,000 shares into 3 rupees and 50 cents. The company stated capital is ordinary shares 500,000 shares, each at 3 rupees and 50 cents. Total number of shares, ordinary shares 500,000 and 3 rupees and 50 cents. Value 1,750,000 rupees. 1,750,000 rupees. Then dividend tax is 10%. So from this value, the tax rate you minus 10% dividend tax. 1,750,000 into 10%. 1,750,000 into 10%, dividend tax rate is 10%, 175,000 rupees. Then how much is the net amount? How much is the net amount? 1750 minus 175, 1,575,000. This is the net cash payment. To shareholders, they get only net dividend amount. So shareholders, they get only net amount of dividend, 1,575,000. The value is cash payment to shareholders 1575. 1575. You have when you pay dividend, you credit cash bank account and debit interim dividend account. Double entry. When you pay dividend, the question is net dividend payment. Net dividend payment. The answer number 5. The answer number 5 is the correct answer. When you pay it, your cash goes down, cash or bank account credit, and dividend account or dividend or retained earnings accounts you can debit, but here the answer given as interim dividend. The interim dividend mean the dividend you pay during an accounting year, during a financial period, you pay dividend, we call interim dividend. To question number 11, to go through it. To question number 11. The trial balance prepared by a company consists of following items: selling and distribution, to administration, finance cost. The company has acquired a machine for administration bill. The machine is for administration purpose. The machine is for administration purpose. The company accounts, we properly classify the expenses. Company account, you properly classify the expenses. Total rent paid for the year for the period is 5 million rupees, and this amount has been recorded under selling and distribution cost. This machine was acquired for the administration purpose but recorded under distribution expenses. So how you correct it? From distribution you minus 5 million. For the administration you add that 5 million rupees. Why? The machine has been acquired for the administration purpose, not for distribution purpose. With the corrected values, 80 minus 5, 75 million station, and finance cost remain constant at 40 million rupees. Selling and distribution 75 million adjusted value. The administration 75 million, finance cost is 40 million rupees. Distribution 75 million, first one we can't take, second one 75, 40. The answer number 2. You select the answer number 2 for the question. Correct expense classification. To question number 12. To go through it. The board of directors of a company wishes to present its financial statements for the year in a relevant and reliable manner. What will make this objective a success? To provide your financial statement in a relevant and reliable manner, you can comply with generally accepted accounting principles. You can use concepts and you have accounting standard also. You can comply with generally accepted accounting principle, which includes common techniques, principle, concepts, standard. The answer number 5. Okay. To provide your information, financial information, more relevant and reliable manner, you can comply with generally accepted accounting principle. Answer number 5. To question number 13 to 15, based on this information, the net profit before tax. The net profit before tax of this company is 266,000 rupees. Following balances extracted. Year ending 31st March 2021. Income tax provision 1920. The 1920 means last year. This is for last year. Tax provision for last year. The tax paid 60,000, cash control account credit debited. This is debit entry. Out of income tax paid during the year, 22,000 being the final payment was applicable for 1920. The 1920 last year. So then you have paid tax 68,000. Tax payment is 68,000. Of that, from 68,000, 22,000 for last year. 22,000 for last year. Then you can identify how much you have paid for the current year. The 68,000 you have paid totally, 22,000 is for last year. 22,000 for last year, then the difference is for the current year. Income tax estimated 2021 current year estimated is 72,000 rupees. Estimated tax for this is for current financial year. Current year. Then the questions. So question number 13. Question 13. What is the income tax expense? Tax expense. The tax expense for the year. Tax expense for the year. Right? We'll make the calculations to calculate the tax expense. So question number 13 to calculate the tax expense. To calculate the tax expense. Question number 13. 13 requirement is to calculate the tax expense. To question number 13. And how we calculate the tax expense? So how we calculate the tax expense? Tax expense equal estimated tax for the current year. Estimated tax for the current year. If it is an under provision, for last year you add, under provision you add, or over provision you minus over provision. You have to do only one of these adjustments. For the estimated tax, under provision you add, under provision for last year you add, if there is an over provision for last year you minus, then you get the tax expense. Right. To refer the question, identify the tax expense. The tax expense given as 72,000 rupees. Tax expense 72,000 rupees. Tax expense 72,000 rupees. Then you have to identify whether it is an under provision or over provision. You have to identify whether it's an under provision or over provision. If you refer to the question information, for last year the company has provided. For last year the company has provided 17,000 rupees. The company has thought of paying 17,000 rupees. But actual payment for last year is 22,000 rupees. The company has thought of paying 17,000 rupees. 17,000 rupees, but actual payment was 22,000 rupees. Right? The company has thought of paying. The company has thought of paying 17,000, but actual payment for last year 22,000 rupees. Right? This here you have under provision of 5,000 rupees. The gap is under provision of 5,000 rupees. Then you plus 5,000 rupees. The plus 5,000 rupees. You calculate tax expense 72,000 plus under provision. You take either plus, and the company can have under provision or over provision. 72 plus under provision, your expense comes to 77,000 rupees. 77,000 rupees. Right. Question number 13 you can answer now. Tax expense is 77,000 rupees. How you calculated it? Estimated tax plus under provision. Plus under provision. But you have to keep in mind here under provision or over provision. Under provision or over provision. The answer, third answer. Answer number 3. So question number 14. What is the profit for the period? The profit for the period. The profit for the period. So question number 14 to calculate profit for the period. And the profit before tax was given in the question. The profit before tax. The profit for the period equal the profit before tax minus tax expense. The profit for the period equal profit before tax minus tax expense. The profit for the year, the profit before tax was given in the question, that is 266,000 rupees. 266,000 rupees. Now the tax expense. The tax expense we already calculated 77,000 rupees. 77,000 rupees. Profit before tax was given in the question. Tax expense we calculated for the previous question. Then 266 minus 77, 9, 8, 189 rupees. 189,000. And go to the question. What's the profit for the year is 189,000 rupees. Answer number 4. Fourth answer. Fourth answer. The calculations. The profit before tax minus tax expense. The profit before tax minus tax expense. So question number 15. What is the income tax liability? The tax liability as at 31st March 21. The tax liability, right? And the usually how you take the liability or payable? Usually the payable equal expense minus paid. From the expense you minus the payment, balance you identify as payable. But income tax liability, you can't take tax expense. Why? Expense includes previous year adjustment. Expense include under provision or over provision. Now these are our calculations. The tax expense equal estimated plus under provision or minus over provision. Then you can't take expense here. So you can't take expense here. Tax payable equal, tax liability means tax payable. The tax payable. The tax liability equal tax payable. Payable. The payable equal estimated tax. estimated tax minus tax paid for the year. Estimated tax minus tax paid for the year. The estimated tax was given in the question as 72,000 rupees. The estimated tax given as 72,000 rupees. Estimated tax 72,000 rupees. The tax paid. And you have paid 68,000, but it includes 22,000 for last year. You have paid 72, it includes, you have paid 68, it includes 22,000 paid for last year. Then you can identify how much you have paid for the current year. 46. Then the 72 minus 46, you can identify the tax liability. Tax liability you can identify 26,000 rupees. Tax liability, how you calculate it? Tax payable, how you calculate? Estimated minus tax paid. What you have to keep in mind properly here, not expense minus paid. Why? Expense includes last year under provision or over provision. So then tax liability equal estimated tax minus tax paid. Estimated tax minus tax paid. The answer is 26,000 rupees. The answer number 5. The answer number 5 is the correct answer. Answer number 5. To question number 16, go through it. Some of the selected financial information from a statement of changes in equity of a company given below. 2020-21. This is your opening balances. This is your closing balances. Retained profits, general reserve, revaluation reserve. The dividend paid for the year. Dividend paid for the year. The profit for the dividend paid was given as 80,000 rupees. 80,000 rupees. This is the dividend payment, 80,000 rupees. The requirement is the profit for the period ending. Based on this information, you have to calculate the profit for the period. Right. And the easiest way, you can prepare a T account to record the retained earnings. But this is question number 16. To question number 16. Easily you can prepare a T account for retained earnings. The retained earnings account. Retained earnings account. Right. And you can record the details in this retained earnings account, retained earnings or accumulated profit or retained profit account. You have opening balance and closing balance. The retained earnings and equity account has credit balances, balance brought forward. So how much is it? 200 will do in thousands. The closing balance 300,000 rupees. The balance carried down 300,000. Then the other information says dividend paid. When you pay dividend, cash control account credit, here we debit cash dividend. How much is it? 80,000 rupees. 80,000 rupees. Then what are the items that has to come here? So what are the values given? What are the values given? Retained earnings we considered, general reserve, this we considered. The general reserve, opening balance 100,000, closing balance 150. So this has increased by 50,000 rupees. General reserve has increased by 50,000 rupees. General reserve increased by 50,000 rupees. How you get money for this general reserve? Usually we make transfers from retained earnings. You make transfers from retained earnings to general reserve. To general reserve. So how much transferred? 50,000 rupees. They have transferred 50,000 rupees. 50,000 rupees. The revaluation reserve has increased. The revaluation reserve has increased. The revaluation gain. The revaluation increase. The revaluation reserve increase by 50. For revaluation reserve increase, it doesn't come to profit. It's a part of other comprehensive income. The revaluation reserve increased by 50 million, it's a part of other comprehensive income, not profit for the year. So these are the information. You can balance this account and identify the GAAP profit for the year. Debit side total is more, 30, 430, 430, and the difference 230 is the profit for the period. Profit for the period. Profit for the period is 230,000. You balance the retained earnings account, you calculate the missing value. 230,000 rupees. The 230,000 rupees, answer number 4. Fourth answer. The answer number 4. 16th question. 230,000. How you got the value? You prepared retained earnings account and you recorded balances given and you calculated the missing value. To go through it. to this information to answer question number 17, 18, 19. Right. The profit after tax of a company, it's 2021 for the year. 400,000. The company incurred losses consecutively last 3 years. The company has been facing losses consecutively for last 3 years. Therefore, dividend has not been paid for last 3 years. You haven't paid dividend for last 3 years. Therefore, dividend further there were no new share issues. You haven't made any share issues. The share capital and reserves as at 1st April 2020 given below. What is the value of equity of this company as at 1st April 2020? Equity value. At the beginning, you can remember I explained you company's equity consists of ordinary share capital, a revaluation reserve, general reserve and retained earnings. State ordinary share capital, revaluation reserve, general reserve and retained earnings. In this company, you have revaluation reserve 200,000 credit balance plus ordinary share capital 30,000 credit balance plus, but retained earnings debit balance, retained earnings debit balance minus, then you can get the equity of the business. 3 minus 1, equity balance is 400,000 rupees. 400,000 rupees. After there is here the company incurred losses consecutively during last 3 years. In the last 3 years, it should be 2020 here. It should be 2020 here. Last 3 years. But the current year there is a profit. Current year there is a profit. For the last 3 years ended 2020. Current year they have a profit. What was the equity at the beginning? You can make calculation here itself. Revaluation reserve plus share capital plus and retained earnings is a debit balance, so you minus 400,000 rupees. The answer is answer number 4, fourth answer. Equity of the business 1st April 2020. According to the question, this is opening equity. Opening equity. Opening equity 400,000 rupees. 17th question. Answer number 4. Right. The 18th question. To go through it. To 31st March 21, the Board of Directors proposed a dividend. Directors propose a dividend. How should this proposed dividend be presented in the financial statements? Presented in the financial statement. Right. The proposed dividend. The proposed dividend for ordinary shares we identify as a non-adjusting event. You will learn under case 10 events after the reporting period. Events after the reporting date, the proposed dividend is not a liability. You identify that as a non-adjusting event. Non-adjusting events you show as a note to the financial statements. Proposed dividend you identify as a non-adjusting event as per case 10. You show that as a note to the financial statement. You show that as a note to the financial statement. the balance of retained earnings account shown in the financial position as at the retained earnings, the opening balance, the retained earnings opening balance, you have a debit balance. The retained earnings, you have opening balance debit 100,000. The current year you have a profit of 400,000. Current year you have a profit of 400,000. Opening balance, the opening balance you have a negative credit debit balance and current year profit 400,000. Then the retained earnings balance, retained earnings balance, opening balance 100,000 is a debit balance. Debit balance, the current year profit for the period 400,000 rupees. Then the balance to be shown in the financial position, minus 100,000 plus 400,000, 300,000. The answer number 5. The fifth answer is a profit for the period plus minus retained earnings negative balance debit balance. The answer number 5, 300,000 rupees. To go through this information, and to use this information to answer question number 21 to 22. The extract of the financial position of a company 2021 and 2020. It's better to identify opening closing balances properly. 20 is the opening balance, 21 is the closing balances. 20 opening balances, 21 closing balances. Dividend paid, the dividend paid. Income tax for the year, tax for the period. Right. The profit for the year we have to calculate. We have to calculate profit for the year. The easiest way, you can prepare the retained earnings account. You can prepare the retained earnings account and calculate the values. Retained earnings account and calculate the missing value. And then we can use the format we used earlier for question number 16. So this is question number 20. Question number 20, calculation. Question number 20, calculations. Of the retained earnings account, this is retained earnings account, you can calculate the missing value. Right. Opening balance, the retained earnings account opening balance is this one, the 13,150, closing balance is 15,350. Right. The opening balance 13,150. 13,150, closing balance 15,350. The 15,350. Right. Remember the transactions. Dividend paid 350. Dividend paid 350. Cash dividend payment 350. 350. Then the general reserve. The general reserve from opening to closing. General reserve from opening to closing. The opening balance is 5,800,000. Closing balance 200,000. 6 million. Opening balance 5,800,000. Closing balance 6 million. General reserve has increased by 200,000 rupees. 200,000 rupees. It increased. The general reserve increase mean you had transferred money from the retained earnings. Double entry, retained earnings account debit, general reserve credit. Retained earnings debit, general reserve credit. And in addition, you have profit for the year. The profit for the year, income tax for the year. The question requires profit for the year means after income tax. After income tax, you can calculate the missing value. Calculate the missing value. The 15,900 debit side total. 15,900 debit side total. You can record in the credit side 15,900 and you can calculate the difference as profit for the year. The 2,750. 2,750,000 is your profit for the period. You add a debit side, record in the credit side, difference 2,750. 2,750,000. The answer number 5. Answer number 5. You prepare the retained earnings account and calculated the missing value. You calculated the missing value. So, question number 21, increase in equity during the year. Increase in equity during the year. The increase in equity you can calculate, or the change in equity, closing equity minus opening equity. Closing equity minus opening equity. Closing equity minus opening equity. So, in this company, equity consists of their stated capital is a part of equity, revaluation reserve. They don't have a revaluation reserve here. Stated capital is a part of equity, retained earnings is a part of equity, and general is a part of equity. So, the equity consists of there are 3 items. Right? Then the question is the change in equity. You can calculate the addition of this opening equity, addition of this closing equity, the change in equity. The opening equity, the 950, 168,950, 350, 221, 350, 223,1,350, closing equity, opening equity 168,950. The gap, the change in equity. Closing equity 221,350, opening equity 168,950. The question number 21 requirement, the 21 requirement, 21 change in equity equal closing equity minus opening equity. Closing equity minus opening equity. We got the calculations. Closing equity 221 350, opening equity 168 950. Change. The 221 350 minus opening equity 168,950 950. The change in equity 52,400,000 52,400. So 52,400 is the answer number 5, the fifth answer. The value of total assets. The value of total assets. Assets equal equity plus liabilities. The total assets equal equity plus liabilities. You can calculate equity plus liabilities. So in this question, equity plus liabilities asset 31st March 2021. So addition of these all will be equity plus liabilities. You attend, get the answer. 296 350. 296,350. 296,350,000. The answer number 5. The previous question, answer 5. Total assets, assets equal equity plus liabilities. To go through information to answer 23 to 26, to go through it. A company commenced the business 1st April 2009, the state capital of 75 million, given following information. For 2 years, the 1920 first year, 2021 second year, 1920 first year, 2021 second year. Total income, total expense excluding tax. Excluding tax. Income tax, dividend payment, revaluation surplus, total assets. Right. To question number 23. What is the value of equity as at 31st March 2020? Equity, the equity, first year equity. First year equity. you have these details. So they have commenced with 75 million rupees of stated capital. The first year they have earned an income of 100 million, expense of 20 million. You plus your income and minus expense. You have first year loss of 20, no tax, no dividend, no revaluation. Then the question is to calculate what is the equity at the end of the first year. What's the equity at the end of the first year? We'll make the calculations. So this is question number 23. Question number 23. We read the question again. What is the equity value? Value of the equity at the end of the first year. At the end of the first year. So how much they introduce? Opening capital plus income minus expense. This is according to this company information. The company commences with, if you refer the question information, company commences with 75 million rupees. The first year, the company has earned an income of 100 rupees, expense of 120. Commence with 75 million, income of 100 million minus expense of 120 million. 120 million. In the first year itself, they have a loss of 20 million rupees. 75 plus 100, 175 minus 120, their equity is 55 million rupees. The equity is 55 million rupees. Equity 55 million rupees. The answer is answer number 2. The 23rd question, answer number 2. What is the value of liabilities? What's the value of liabilities as at 2020? The first year liabilities. If you remind the accounting equation, this is 24. 24. And the accounting equation, assets equal equity plus liabilities. Equity plus liabilities. Right. So in this question information, assets given as 80 million rupees. Assets given as 80 million rupees. Equity we found. Equity we found. This is equity value. Now you can calculate the missing value as the liabilities. The missing value is the liabilities. Assets equal equity plus liabilities. Assets equal equity plus liabilities. Assets 80 million, equity 55 million. The difference is your liabilities. Difference is your liabilities, 25 million rupees. 25 million rupees. Answer number 2. Second answer. Answer number 2. 25 million rupees. What is the value of retained earnings? Retained earnings 31st March 2021. Retained earnings closing balance. Retained earnings closing balance. To question number 25. To 25. And if you consider the first year, this company has earned a loss. First year, the company has earned a loss. That is their opening balance. Opening balance is here, income minus expense, loss of 20,000. Opening balance, they have a loss of 20,000. How? Last year income is 100 million, expense 120 million, they have a loss of 20. So this loss. Last year. And the current year, or we can say for the year, so they have an income. So this year income is 150. This year's income. And the current year expense is excluding tax, 90 million rupees. The 90 million rupees. Then the current year they have tax payment 20 million tax payment. The retained earnings opening balance, negative value, current year income minus expense minus tax. Income plus expense minus tax. You have profit of 40 million profit for the year. The profit for the year is 40 million rupees. But the current year, this company has made a dividend payment. Current year, they have made a dividend payment. The dividend payment 10 million. Your retained earnings decreased. The retained earnings will decrease when you pay dividend. The answer is 10 million rupees. The answer is 10 million rupees. The answer is 10 million rupees. How you get this? Opening balance, debit balance. Why? Last year expense exceeded your income. So for the year you have income of 150, expense of 90, tax payment 20 and dividend payment 10. Retained earnings account you have 100 million rupees. 10 million rupees. 10 million rupees. The 25th question, what is the value of retained earnings at the end of the second year, 21, they have retained earnings balance 10 million rupees. They have 10 million rupees retained earning balance. The 26th question, again based on the same information, what is the value of equity at the end of 2021? The equity value. The equity value at the end of 2021. According to this company's information, they have equity value, stated capital, ordinary shares, stated ordinary share capital. The company has commenced with state capital, ordinary share capital you have 75 million. The retained earnings, so how much? Retained earnings account, we have 10 million rupees. The retained earnings account we have 10 million rupees. Retained earnings we have 10 million rupees plus revaluation reserve. The revaluation reserve they have given 15 million rupees. Your equity. So equity consists of, according to this company's information, the ordinary share capital 75 million they commence and a retained earnings of 10 million plus their evaluation reserve is 25 million. Altogether, their equity is 100 million rupees. Their equity is 100 million rupees. Stated ordinary share capital, revaluation reserve and the general reserve. 26, answer number 4. The 27 to 30 to go through this. The following balances were extracted from book of company 2020. Share capital, ordinary share, revaluation reserve, general reserve, total liabilities. Other information. The retained earnings. So this is now, if you compare these dates, 2020, this is 2021. To identify the dates properly, 2021, then we can say 21 and 20. 20 is your opening balances, 21 your closing balances, opening balances and closing balances. The profit for the year, current year profit. Dividend paid 31st December 2020. So then accounting period 1st April 2020-21 means this dividend you have paid during the year. Net increase in total assets. Net increase in total assets, and this is not a minus value, this is dash. So here dash, here dash, dash, here also dash, otherwise you will misunderstand this is negative value. No, this is dash, this is dash. Net increase in total assets, asset increase. Again I emphasize you, this is a dash, not a negative value. Dash, dash, right. Then what is the value of retained earnings? What's the value of retained earnings as at 31st 2020? The 2020 date is clear. Opening balances. Now this is the retained earnings account. Closing balance is given. The retained earnings closing balance is given. The question requirement is opening balance. The easiest way, you can prepare a T account for retained earnings. Easiest way, you can prepare a retained earnings account to get the opening balance. The retained earnings account. The retained earnings account. So when you do the retained earnings account, this is for the question number 27. So this is 27. Question number 27. If you read the question again, what is the value of retained earnings as at 31st March? As at 31st March 2020. So this opening balance you have to calculate. Opening balance is missing. the opening balance is missing, you have to calculate it. We'll take the question information. Retained earnings as at 31st March, closing balance. The retained earnings closing balance is given as 27,000. Retained earnings closing balance is 27,000 rupees. What are the other items you record? What are the other items you record? Net profit for the year. Retained earnings closing balance we recorded now. We recorded the profit for the year. The profit for the year in the retained earnings account you credit. The profit how much? 12,000 rupees. 12,000 rupees. The profit for the is 12,000 rupees. And dividend paid. Dividend paid is 6,000 rupees. When you pay dividend, cash control account credit, you debit it here. The dividend payment, how much? Dividend 6,000 rupees. Dividend payment is 6,000 rupees. So what are the other items? You can adjust it here. No. Usually we adjust transfers general reserve. Here you don't have transfers. Here you don't have such transfers. Then you can calculate and get the balance. 27 plus 6, 33,000. 33,000. Opening balance 21,000 rupees. Opening balance is 21,000 rupees. Opening balance. Retained earnings, opening balance. Closing balance was given, dividend payment, profit for the year, opening balance. So what's the answer for the question number 27? Answer number 121 million rupees. The 28th, what is the value of total assets? So what's the value of total assets of the company as at 31st March? As at 31st March 2020, opening assets value. How can you calculate? The basic accounting equation, assets equal equity plus liabilities. Basic accounting equation, assets equal equity plus liabilities. Now we have other details, you can calculate the missing value. This is question number 28. 28. What's the value of total assets of the company as at this date? Opening assets. The opening assets value. Right. The basic accounting equation, assets equal equity plus liabilities. Assets equal equity plus liabilities. The liabilities 40 million. If you refer the question information, liabilities given as 40 million rupees. Liabilities given as 40 million rupees. Then the equity. Equity in this company, if you refer back the question information, stated capital is given, that's their part of equity. Equity 15,000, part of equity, general reserve, part of equity, and retained earnings we found. For these three, you can adjust the retained earnings. For these three, you can adjust the plus retained earnings. Then you get the equity. You have stated capital, revaluation reserve, general reserve, then you get plus the retained earnings, you get the equity. Right. If you take the values of the stated capital, it was there. Stated capital how much? 45 million. 45 million. And revaluation reserve 15 million. Revaluation reserve 15 million. And general reserve 5 million. General reserve 5 million. At the retained earnings, previous question we calculated 21 million. Retained earnings 21 million. Can get the value. The total it comes to 86 million. You can get assets. The assets equal equity plus liabilities for this. 86 plus 40, 126. 126. Answer number 5. The fifth answer is the correct answer. 28th. 28th answer. 126 millions. How you calculated? Assets equal equity plus liabilities. The assets equal equity plus liabilities. To read question number 29, the 29th question. So what's the value of equity 31st March 2021? Equity closing balance. Closing equity. Closing equity. Closing equity value. I calculate here equity value. You can make the calculation for this values. Other question number, this is 29. The stated capital remains constant 45 million. Stated capital remains constant at 45 million. No share issues we found. No share issues we found. Now the revaluation reserve 15 million. The revaluation reserve 15 million. Plus general reserve 5 million. General reserve 5 million. And the retained earnings closing balance 27 million. Retained earnings closing balance 27 million. The 45 million, 15 million, 5 million plus general reserve 27 million. 92 million rupees. The addition comes to 92 million rupees. The 29th question answer 92 million rupees. The 92 million rupees is the answer closing equity. Answer number 4. To question number 30. What is the value of total liabilities 31st March 2021? Closing liabilities. So you have to calculate the closing liabilities. The closing liabilities calculation. Right. So here again you can use the basic accounting equation. Here again you can use the basic accounting equation. Assets equal equity plus liabilities. Right? Assets equal equity plus liabilities. Equity, no issue. Previously we calculated how much? It's 92,000. Equity value 92,000. Equity 92,000. Assets. And in the previous question, assets we calculated opening. Right? Opening assets we calculated the 126 opening assets. If you go back to the question, it says the net increase in total assets. Net increase in total assets 15 million. 15 million. Net increase in total assets. Then you can calculate the closing assets. The opening assets how much? 126 million. 126 million. How you got? Here the question number 28. Question number 28 we calculated it. Question number 28. Right? This is question number 28. 28. Then in the question information it says net increase in assets. Net increase in assets. Assets increased by how much? 15 million. Assets increased by 15 million. Then how much the closing assets? 141,000. 141,000. Then you can calculate the missing value as the liabilities. You can calculate the missing value as the liabilities. 141 minus 92, 949. The 49 million. ₹49 million. 49 million rupees the answer. Right. Question number 30, answer number 4. Right. So we discuss now MCQs. We'll discuss now another few objective type questions. Right. You know the paper first 30 questions MCQs, multiple choice questions. 31 to 50 you get objective type questions. So question number 31. The state two items that are presented under equity in the financial position. Equity under financial position. The equity consists of ordinary share capital, revaluation reserve, general reserve and retained earnings. Under equity we show ordinary share capital, revaluation reserve, general reserve and retained earnings. Ordinary share capital, revaluation reserve, general reserve and retained earnings or retained profit or accumulated profit. 32. the state 2 transaction except income which increase equity of an ordinary shareholders. Right? Usually you have income increase equity, but it says except income. The except income what we have if the company make a new share issue, equity increase, especially rights issue. The capitalization we don't take, right? Rights issue, new issue of shares, or we can say a rights issue. Except income, you can write rights issue of shares. And revaluation gain, right? Especially the first time revaluation gain, for the first time. The rights issue only capitalization of reserves you can't write. Why? In a capitalization what happen? You take money from a reserve, is a transfer entry only. The rights issue of shares and first time revaluation gain for first time. The 33. State the accounting treatment for income tax and provision for warranty. Accounting treatment, you can write the double entry or how you do in a sentence. Accounting treatment, provision for warranty and income tax. Right. And the income tax for the year. You record as an expense. In the statement of profit or loss and other comprehensive income. You record as an expense in the statement of profit or loss and or other comprehensive income. Statement of profit or loss and other comprehensive income. The provision for warranty, closing balance. The provision for warranty you are learning in LKS 37. Provision for warranty, closing balance you record as a current liability in the statement of financial position. Closing balance of provision for warranty account you record as a current liability in the statement of financial position. Current liability in the statement of financial position. So 34. Let's take the double entry to record following transactions. The double entry to record the following transaction. Transfer to the general reserve. You have transferred general reserve 2,500,000 rupees. You have transferred 2,500,000 rupees to the general reserve. But from where you transfer? You transfer from retained earnings. The retained earnings account debit how much? 2,500,000 rupees. Retained earnings account debit 2,500,000 rupees. Where to transfer? To the general reserve. The general reserve account credit 2,500,000 rupees. When you transfer to general reserve, retained earnings account debit 2,500,000, general reserve account credit 2,500,000. Retained earnings debit. Why? You transfer from retained earnings. General reserve account credit. Why? You transfer to the general reserve. To question number 35. Some of the selected financial information of a company is given below. Retained profit, general reserve, revaluation reserve. The 2020 balances and 21 balances. 21 then should be closing balances. This should be opening balances. Closing balances and opening balances. Retained profit, general reserve, revaluation reserve, dividend paid. Dividend paid during the year. The question is, the profit for the year would be. The profit for the year would be. So calculation question. Profit for the year should be. You can make a small calculation through retained earnings account. You can prepare a retained earnings account and you can get the missing value. You can get the missing value in the retained earnings account. Now, this is question number 35. Question 35. And you can prepare the retained earnings account and there you can calculate the missing value. Retained earnings account. And you can do in thousands. Retained earnings account, you can calculate the values. Opening balance and closing balances. Opening balance, closing balance. Opening balance and closing balance. So what are the opening and closing balances? Opening balance, retained earnings account, retained profit account 3,000. The closing balance 5,000 rupees. You can record the opening balance 3,000, closing balance 5,000. What are the other transactions? Based on the information given in the question, other transactions. You have paid dividend 1,100. When you pay dividend, cash control account credit, retained earnings account debit. Cash dividend payment. How much? 1,100. 1,100 dividend payment. And in addition to that, your general reserve. The general reserve last year 1,000, current year 2,000. So the general reserve has increased by 1,000. General reserve has increased by 1,000. The last year 1,000 rupees, current year 2,000. The general reserve increased by 1,000 rupees. To general reserve, you usually transfer from the retained earning. To general reserve. How much is it? 1000 rupees. Then you can balance the retained earnings account, identify the profit for the year. You identify the profit for the year. The 7100, 4100 is the profit. The profit is 4,100,000 rupees. In the retained earnings account, you calculated the missing value. You calculate the missing value. This is the profit for the year. Then the answer should be, how much we got? We got rupees 4,100,000. 4,100,000 rupees. How you got the answer? You prepared the retained earnings account and got the missing value. To 36. See the double entries. The double entries relate to following transactions. The first one, a capitalization of 100,000 ordinary shares each at 15 rupees using its revaluation reserve. 100,000 shares at 15 rupees, 1,500,000 rupees. 1,500,000 rupees. Double entry. When you capitalize, common double entry, whatever the reserve you debit, stated capital account you credit. Right? Here the question specified revaluation reserve. Revaluation reserve account debit, how much? 1,500,000. Revaluation reserve account debit 1,500,000. Where to credit? To stated ordinary share capital account credit. Stated ordinary share capital account credit. How much? 1,500,000. Now, don't write these letters, write the complete word in. To manage the space only, I am writing the letters. Stated ordinary share capital account credit. When you write exam answers, make sure that you are writing the complete answers. Just to manage the space only, I wrote the letters. Stated ordinary share capital account credit 1,500,000. Reserve decreased, you debit. Share capital increase, you credited. The receipt of cash from the issue of 150,000 shares, right shares, each at 20. 150,000 shares at 20, you get 3 million rupees. 3 million rupees. Here then when you are recording this, no need to open a share issue account. At once you can debit cash control account. If you want, you can open a temporary account, share issue account, but not required here. Cash control account debit, how much? 3 million rupees. 3 million rupees. cash control account debit 3 million rupees, credit where to stated ordinary share capital account credit 3 million rupees. So again I remind you not to write letters, write the complete word stated ordinary share capital account credit 3 million rupees. When you write the exam answers, don't use letters like texting with people. Write the complete word stated ordinary share capital account credit 3 million rupees. So question number 36. To state why provision is reported differently from reserves in the financial statements. Right. The provisions you made for two purposes. One is to reduce the value of assets. Another purpose to increase the value of liabilities. The provisions you made for two purposes. I'm just explaining you the information. Provision you made to increase the value of liability. Example, provision for income tax to increase liabilities. The provision for warranty to increase the liabilities. So certain provisions you make to reduce the value of assets. Example, provision for depreciation to reduce the value of property, plant and equipment. Reserves. The reserves are part of your equity. State why provision is reported differently from reserves. What's the reason? As the provisions are made to reduce the value of asset or to increase liabilities. Provisions you made to reduce the value of assets or to increase the liabilities. But reserves are part of your equity. That's why you separately, differently record it. Provisions you made to reduce the value of assets or increase the value of liabilities, and reserves are part of your equity. To go through the information, from question number 38 to 41, a company commenced business with a stated capital of 500 million. So commenced with 500 million of stated capital. Has given information 2021, 1920. So 1920, this is their first year. This is their first year. 2021, this is their second year. Okay. You have 2 years details, first year details and the second year details. First year details and the second year details. Revenue means your income. income, total expense, dividends paid, rights issues, total assets. So, question number 38, what was the equity as at 31st March 2020, that is end of first year, end of first year, equity. So, if you take the opening capital of this company, they have commenced with 500 million, they have commenced with 500 million. Then you can take stated capital, opening balance, how much? 500 million, 500 million. Right. And the first year income 300, expense 120. Then you can consider first year profit. You can take first year profit. How much is the profit? The profit equal income 300 million, expense 180 million. So, first year profit is 120 million. The first year profit is 120 million. And the first year this company has paid a dividend. First year this company has paid dividend of how much? 40 million. So, your equity decrease. Once you pay dividend, your equity decrease. And if you refer back the details, dividend, the company has made a rights issue. The company has made a rights issue. Rights issue will increase your equity. Rights issue will increase your equity by 20 million. Then you get your closing equity. Then you get your closing equity. Right? 620, 640, 600 million. 600 million. Answer is, for 38, answer 600 million rupees. 600 million rupees. Opening stated capital, added profit for the year, added dividend, deducted dividend, and your rights issue at. You get 600 million rupees. The 600 million rupees. So, what was the liabilities as at 31st March 2020? Liabilities. The total liabilities 31st March 2020. The first year ending liabilities. The first year ending liabilities. Here you can use your basic accounting equation, assets equal equity plus liabilities. Assets equal equity plus liabilities. The question has given you assets, that has no issue. Assets given as 1300. Assets given as 1300. If you go back to the previous question, you got 600 million equity. You got 600 million equity. 600 million equity, then you can calculate the liability value. You can calculate the liabilities value, how much? 700 million. In the answer, you write complete answers, rupees 700 million. 700 million rupees. 700 million rupees. Question 40. What was the equity as at 31st March 2021? 31st March 2021 second year ending equity. Right. If you go back to question number previously, you calculated equity end of last year, or equity as at 31st March 2020. You got 600 million. Equity as at 31st, or you can say equity as at 31st March 2020, 600 million we already calculated. Then the current year profit. The current year profit 2020-21 profit. The profit is income minus expense. Once you refer question information, income 400, expense 300. 100 is the profit. And the first, this year, current year you have paid dividend of 20. The current year you have paid dividend of 20. Dividend paid. When you pay dividend, your equity decreases. When you pay dividend, your equity decreases. The rights issues. The company has made a rights issue of 80,000. Rights issue of 80,000. Then you can calculate equity balance. 600, 700, 780, 760 million rupees. The answer 760 million rupees. For the opening equity, you added current year profit, current year dividend payment, deducted, and you added rights issue. To 41, what was the liabilities? Same company, closing liabilities. Again, you can use assets equal equity plus liabilities. Right. The asset is given in the question. The asset is given in the question. How much? It's 1,600. Equity we calculated in the previous question. How much? 700 million. You calculated 700 million. Equity you got 760 million. The 760 million. You can calculate the value. Assets equal equity plus liabilities. Assets 840 is the missing value. So answer is 840 million rupees. The answer is 840 million rupees. Another important area to identify comprehensive income profit for the annual. The following information relates to the company. sales, cost of sales, operating expense, gain on sale of motor vehicle, interim dividend paid, revaluation deficit, office equipment, revaluation surplus. Okay. This office equipment, this is building. A surplus of 100,000 has been recognized on the revaluation of office equipment. In the previous year, 2020 is the previous year. So, office equipment, current year you have a deficit, but there is a gain, surplus, revaluation surplus or gain in the previous year. But the building has been revalued for the first time. The building for the first time revaluation. First time revaluation. So, question number 42. What was the total income? Total income and total expense recognized. Total income and total expense. Right. Income, expense. Total income and total expense. Right. If you refer the question detail, what are the items you take to the income? Income. Sales. The sales you record as an income. How much? 7,200. The cost of sales is an expense for 3,100. Cost of sales expense. The operating expenses 140. You record as an expense, operating expense. Gain on sale of motor vehicle. The motor vehicle gain. How much? 120. It's part of your income. Interim dividend is a part of distribution, not income or expense. You record in the statement of changes in equity. Revaluation deficit. Right? The revaluation deficit. 130. Building revaluation gain. Revaluation gain on building. Revaluation gain on building, you have 250. Then total income, total expense. Total income, total expense. This revaluation deficit on office equipment. You can add and get the total. 570. 3,370. Total income. Answers 7,570,000. 7,570,000. Total expense 3,370,000. 3,370,000. So what you should learn here? In the recognition of income and expense for the year, we don't consider previous revaluation results. In the recognition of income and expense for the year, you don't consider previous revaluation results. That point you have to learn here. Total income is 7,570,000. Total expense 3,370,000. Right. The 43, the profit and other comprehensive income. 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 Sales is a part of your profit. Sales 7,200. Cost of sales. Cost of sales is a reduction, expense you minus. Operating expenses, operating expense 140 you minus. The motor vehicle gain, motor vehicle gain 120 you plus. Sales you deduct, sales you added, cost of sales minus operating expense minus motor vehicle gain plus. Then the revaluation results, revaluation deficit of equipment, the revaluation deficit from equipment, revaluation deficit from equipment. The last year you have a gain 130, you have a gain, you recover it, balance loss only you record under other expenses. Then for that 100 you have to minus from the revaluation under other comprehensive income. This 100, so this 100 you have to recover, revaluation deficit recovery from equipment, revaluation deficit recovery, recovery of revaluation deficit of equipment. Total loss you got 130, but 100 you can recover, 100 you can recover, that you record as a reduction of other comprehensive income. So this 100 recovery is a reduction of other comprehensive income. So you have build-in first time gain, build-in revaluation gain, revaluation gain from build-in 250 is a part of other comprehensive income. Then here equipment, again I emphasize you, recovery 100 you record as a reduction of other comprehensive income, you record as a reduction of other comprehensive income, balance loss only other expenses, the balance loss only other expenses. Right? Sales we recorded, cost of sales we recorded, 140 operating expense, motor vehicle gain we recorded, revaluation of equipment, remaining loss, remaining loss. And to get profit for this 4,50,000 rupees. The profit for the year is 4,50,000 rupees. Other comprehensive income, you get 150 rupees net amount, 150 of net amount, 150 net amount. The profit is 4,50,000, other comprehensive income 150,000 rupees, other comprehensive income 150,000 rupees. The 44 total comprehensive income and retained earnings. So total comprehensive income equal the profit plus other comprehensive income. Profit plus other comprehensive income. How much is the profit? 4,050. How much is other comprehensive income? 150. 4,050 plus 150. 4,050 plus 150 other comprehensive income. We calculate the previous question. To get 4,200,000. The 4,200,000 retained earnings. The retained earnings equal how much you retain. retained earnings equal profit minus dividend paid. Profit minus dividend paid. The profit, how much you got? 4050. Dividend payment given 200. The profit 4050. We calculated dividend 200. The dividend 200. 3,850,000 rupees. 3,850,000 rupees. Total comprehensive income, profit plus other comprehensive income, retained earnings equal profit minus dividend paid. Profit minus dividend paid. If you want the calculations again, total income, total expense, profit, other comprehensive income, total comprehensive income, and retained earnings. The last 5 questions, 45 to 50, based on same information. To go through it. And you have 2 years details, 2021 and 20 details. The 2020 details we can say opening balances, 21 details closing balances. Opening balance, closing balances. Dividend paid belongs to current financial year. Tax for the year, proposed dividend. Those are the details. Right. The ordinary share, revaluation reserve, retained earnings, general reserves are their equity. Total liabilities, here it is total liabilities, and here non-current liabilities. What's the gap? The total liabilities consist of non-current liabilities and current liabilities. From the total liabilities, when you minus non-current, you'll get current liabilities. You got the questions. Right. Owner's equity at the as at 31st March 2020. 31st March 2020. This is opening equity. Right? Opening equity. 46 owner's equity 31st March 2021. Closing equity. Closing equity. Right. And here equity consists of the ordinary share capital, evaluation reserve, retained earnings, general reserve. The opening date, you can take this addition of this. Closing date, addition of this. Addition of these three. Here you have 11,000. Closing debt 19,000. 19,000. Then you can write the answers. The opening equity, how much you got? Opening equity you got how much? Previous question, previous page, 11,000, 19,000. The opening equity how much? 11 million rupees. Rupees 11 million. Closing equity we got 19 million. Closing equity 19 million. Increase in owner's equity during the year. Increase in equity, closing equity minus opening equity. Closing equity minus opening equity. So closing equity how much? Calculated 19,000. Opening equity 11,000. So equity has increased by 8 million rupees. Equity has increased by 8 million rupees. The closing equity minus opening equity. The profit for the year. Right? This is now usual question why we prepare the retained earnings account. Right? We prepare the retained earnings account. You can calculate through retained earnings account. You can calculate through a retained earnings account. This is 48. To question number 48. And you have details now. You can update this account and calculate the missing value. The retained earnings account, opening balance. We have question detail 3,000. Opening balance you have 3,000. The closing balance 7,000, 7 million rupees. Dividend payment given as 1,500. Dividend payment 1,500. And so if you refer the question, general reserve has increased by general reserve. If you refer the question details, general reserve last year 2,000 given in the question. This has increased to 3,000, mean you have transferred 1,000 rupees to general reserve. You have transferred 1,000 rupees to general reserve. From where we transfer? Retained earnings. Retained earnings account debit. So you can balance this and get the profit for the year. The profit for the is 6,500,000 rupees. Profit for the is 6,500,000 rupees difference. The profit for the is 6,500,000 rupees. So question number 49, the value of total assets. The total assets 2020 opening assets. Opening assets. So again here you can use accounting equation. The profit equal accounting equation, assets equal equity plus liabilities. Assets equal equity plus liabilities. plus liabilities. And the equity we found, opening equity 11 million. Liabilities given in the question, the total liability is 5 million rupees. If you have doubt, this was calculated in question number 45. Question number 45, we calculated, and we have 16 million rupees. 16 million rupees. Assets equal equity plus liabilities. The answer you got assets equal equity plus liabilities. How much you got? 16 million. The last question, question number 50, value of total assets. Right? Total assets, closing assets. Right? Again, you can use the same equation. The assets equal equity plus liabilities. Assets equal equity plus liabilities. How much assets? Assets we got to 26 million. 26 million. So assets you got 19 million. Assets 19 million. Where you got this? In question number 46. Question number 46 we calculated. Liabilities given in the question, that is 7 million rupees total liabilities. Total liabilities. The assets equal equity plus liabilities. 19 plus 7, 26 million rupees. 19 plus 7, 26 million rupees. To hear the answer, 26 million rupees. Right. 45, 11 million rupees. 46, 19 million rupees. 47, 8 million rupees. 49, 6.5 million rupees, 6,500,000. 49, 16 million rupees. Last question, 50th one, 26 million rupees. Right. And we discuss questions covering company accounts, financial statements. Company account, financial statements. We discuss 30 MCQ questions and 20 objective type questions. Right. And as you are aware, the company account is very important area in the syllabus. Right. And this is ongoing series of lessons organized by the Bank of Ceylon, Bankers to the Nation, under the concept of NanaJaya program. Right. And that here, and I am also lucky to be a part of this group to share my knowledge with you all by discussing specific lessons in the syllabus. And as a Bank of Ceylon, as a Bankers to the Nation, thinks about our future, because our future, if you properly study it only, our future is safe. Once you properly study only, our future is safe. So as the Bank of Ceylon, Bankers to the Nation always thinks about our future. So your future, if you properly learn only, we have a future. Our future is protected. And whatever the issue or challenges come, I am sure that you will study and you will serve our country. Right? If you properly study it and if you properly save our country, save and serve both. You have to save the country and you have to serve the country. Serve and save, then our country will be a better place in the future. Right? So before ending the lesson, I must thank you. I must thank to the Bank of Ceylon, for inviting me to conduct this series of seminars. Until we meet from another lesson, I say, I want to stay safe and thank you very much.